Welcome to Smartwell with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at DICK's sporting goods.
If you find our talks useful, please consider subscribe, like, and comment underneath because today we are really getting into a pretty wild situation with a major retailer.
Oh, yeah.
Like the floor just completely fell out from under it.
It really did.
If you were watching the ticker on August 25th, 2026, it looked like the wheels were flying off.
Absolute free fall.
Right. I mean, the stock collapsed 30.68% in a single trading session. It hit a 52-week low of $124.31. And, you know, when a company loses a third of its value in a matter of hours, you have to ask yourself, is this a falling knife that's just going to keep cutting you?
Or is it a bargain?
Exactly. Is this a fundamentally misunderstood opportunity?
Right. And we'll get into the mechanics of that drop and whether it's a trap or a bargain right after a quick word on how we organize our research. Because for long-term investors tracking these kinds of massive market dislocations, you can actually explore StockOracle through the special 14-day trial link below in the description.
Mm-hmm.
StockOracle brings company fundamentals, OracleIQ stock appraisal, OracleValue intrinsic value estimates, AI moat analysis, bull and bear insights, stock comparisons, watch lists, and portfolio tools all into one single place.
Right. But just to be totally clear, while it can help organize your research, it is absolutely not financial advice or a recommendation to buy or sell anything.
Right, of course.
AI analysis and those intrinsic value estimates can be incomplete or, honestly, just plain wrong. Plus, market data might be delayed, so you always have to verify important facts and make your own decisions.
Absolutely.
And full disclosure, this is an affiliate link, so we may earn a commission if you use it, but at no extra cost to you.
All right, so let's get into this 30% collapse because it's fascinating. Management had just cut their full year 2026 guidance.
Right.
And they pointed to two massive headwinds. First, just general weakness in the footwear and apparel markets. But second, and honestly, much more importantly, they are having severe struggles integrating their recent acquisition of Foot Locker.
Yeah, and that second point, that is what really caught my attention. Because for a long-term investor who's, focused on protecting capital, this sets up a really fascinating but very dangerous market divergence.
It really does.
Yeah.
What we're seeing right now is the market taking a very severe Foot Locker discount and just applying it to the entire combined enterprise.
Wow.
And the reason this is such a stark divergence is that the core legacy DICK's business, it remains incredibly resilient.
It's still doing well.
Yeah, in Q2 of 2026, that core banner actually posted 4.9% comparable store growth.
Which is huge.
It is. I mean, generating almost 5% growth at existing stores in a really soft consumer environment, that means the underlying franchise is incredibly healthy.
Yeah, they're taking market share.
Exactly. But because the Foot Locker integration is dragging down forward guidance and creating all these near-term operating losses, investors are just pricing the whole company as if the main engine is completely broken.
But see, this is exactly where my capital preservation alarm bells start ringing.
Okay, how so?
Well, I look at the setup and I wonder if it fits the exact profile of a classic value trap. Yes, we have a solid legacy business, but they went out and bought a massive struggling footprint.
Right.
So protecting our capital means we have to ask a really uncomfortable question. Is this Foot Locker drag just a temporary integration hurdle?
Like a couple bad quarters of cleanup.
Exactly.
Yeah.
A little restructuring. Or did they just permanently impair the cash flow of the entire company?
Well, to answer that, we really have to look under the hood at the actual business fundamentals. Because they're basically two completely different stories playing out on the income statement right now.
Okay, let's hear them.
If you look at the top line, the revenue growth is just massive. Q1 2026 revenue hit $5.165 billion, and that is up 62.7% year over year.
Wait, 62%?
Exactly, 62%.
Just in one quarter.
Yeah. Now, obviously, that is entirely fueled by absorbing the Foot Locker acquisition into their accounting.
Right. You buy a giant company, your revenue goes up.
Exactly. But even on a trailing 12-month basis, revenue growth is sitting at 41.22%.
Okay.
And they have maintained a fortress of a balance sheet to support all this integration. They're sitting on nearly $1 billion in cash.
Nice.
And $5.6 billion in stockholders' equity, with zero confirmed long-term debt tagged recently.
Really? Zero?
Yeah, though with integration costs, you always want to verify if that debt picture is shifting in real time.
Right, because things move fast. Okay, so I see the top line explosion.
Yeah.
But from a practical wealth building standpoint, revenue is vanity and profit is sanity.
Very true.
Where this gets really concerning to me is the margin compression.
Yeah, it's rough.
It really is. The net margin dropped to 6.19% in Q1, and that's down from 8.33% a year prior. And on a trailing 12-month basis, it's ground all the way down to 4.71%.
That is the Foot Locker anchor just pulling them down.
Exactly. This lower margin Foot Locker business is diluting the profitability of the whole machine. I mean, let's look at the specific damage because the mechanics here are brutal.
Let's do.
Foot Locker posted a $31.9 million quarterly operating loss.
Wow.
Right. It isn't just underperforming, it is actively burning cash. And if you look at the free cash flow proxy for Q1, it's negative $84.2 million.
Right, and we have to explain why that cash flow is negative.
Yeah, why are they bleeding so much cash?
Well, it's because capital expenditures just skyrocketed to over $360.7 million in a single quarter.
Wait, $360 million in CapEx, that's a staggering amount of money.
It is, but think about how retail integration actually works. You don't just buy a company and instantly make money.
Right, you have to fix it up.
Exactly.
Yeah.
That $360 million is likely going toward fixing broken IT systems, merging warehouse logistics, and physically remodeling rundown Foot Locker locations.
So it's basically a massive construction project.
Exactly.
And that tension, right, a highly profitable core business chained to a very expensive cash-draining construction project, that is exactly what is driving the stock price right now.
Spot on.
So if we step back, how do we actually map out the long-term growth drivers here? Where does the future compounding actually come from?
Well, we can break their compounding engines down into three specific buckets. You have the existing engine, the emerging engine, and optionality.
Okay, let's start with the existing engine.
So that is the legacy banner. Like we mentioned earlier, it's still the primary value creation engine.
Right, the 4.9% growth.
Exactly. Gaining market share with that kind of comp growth when the rest of the industry is struggling, that proves real brand strength. Consumers are still walking into those stores and spending money.
Okay, and the emerging engine.
That's all about revenue scale. By absorbing Foot Locker, they are now operating at a $5 billion plus quarterly revenue base.
Which is massive.
It is. And when you understand the mechanics of retail, scale is everything. When you are buying that much inventory, you suddenly dictate procurement terms to vendors.
Right. You get better pricing.
Exactly. Better pricing on sneakers, better payment terms, and you can cross-merchandise inventory across all your banners. If they integrate this properly, the profit leverage is just massive.
Yes, so better margins eventually. And the third bucket, optionality.
That's store rationalization and capital return. Management isn't just sitting on their hands with these losing stores. They're actively closing 110 Foot Locker locations in fiscal 2026.
Which is how you mathematically cut that $31.9 million operating loss.
Exactly.
You identify the specific physical stores that are bleeding cash, where the rent and the payroll cost more than the shoes they sell, and you just shutter them.
You have to. And on top of that, management declared a $1.25 dividend.
Okay, so a little yield.
Right. It provides a little bit of yield support to pay investors while they wait for this whole turnaround to happen.
Looking at this whole setup, it really reminds me of real estate.
Oh, yeah? How so?
Well, it's like you just bought this beautiful, fully renovated, cash-flowing duplex.
Okay.
The main house is perfect. The tenants are paying. Everything is great. But the previous owner attached this leaky, incredibly expensive, half-finished extension to the side of it.
Right. And that extension is Foot Locker.
Exactly. Foot Locker is the leaky extension. And right now, all the rental income you're making from that beautiful main duplex is being completely drained just to fix the plumbing in the leaky extension.
That is a perfect analogy.
So the obvious question for an investor is, how much time does management have to call a plumber before the whole house floods?
Right.
What is the actual timeline for these repairs? When do we actually see proof that this is getting fixed?
Well, that takes us directly into the catalyst roadmap.
Okay.
The timeline of events that could move this stock is pretty clearly defined in three phases.
Walk me through them.
In the near term, so looking out 3 to 6 months, the critical checkpoint is the Q3 2026 earnings report, which will likely drop in November.
Right.
This is where we need to see if those 110 store closures are actually working. Are they successfully narrowing that $31.9 million operating loss?
And we also need to see if the core duplex is still generating rent.
Right.
Is that 4.9% growth holding up against macro consumer weakness?
Exactly. Then moving to the medium term, the 6 to 12-month window, we're looking at the full year 2026 results and the initial 2027 guidance in March.
Okay, so seeing the full picture.
Right. That's the moment of truth to find out if Foot Locker is realistically approaching operating break-even.
Got it.
And finally, in the long term, investors are going to be waiting for an investor day or some major strategic update that validates the supply chain integration and actually puts hard dollar amounts on those synergy targets.
Oh, wait, I have to push back a bit on those near-term catalysts, though.
Oh, yeah.
Yeah, I mean, let's look out the window at the actual economy right now. Even if management executes these store closures perfectly, they are swimming against a very strong macroeconomic tide.
That's true.
The company themselves flagged a challenging environment for athletic footwear and apparel. I mean, we saw Nike shares drop in sympathy on this exact news.
We did.
So my concern is that a totally tapped-out consumer environment could easily overshadow any company-specific operational improvements. If people simply aren't buying $200 sneakers right now, does fixing the back-end supply chain even matter in the short term?
That is a very fair point. I mean, the macro environment matters, and they don't operate in a vacuum. But this is where we really have to look at what is actually priced into the stock.
Okay.
Because if these catalysts take months to materialize, how is the market valuing the company today? The valuation and expectations are where the spring is tightly coiled.
Run the numbers for me.
All right, right now the stock trades at a trailing PE ratio of 19.89.
Okay, not terrible.
But the really shocking metric is the price-to-sales ratio. It's sitting at 0.94.
Wow. Let's just explain what that actually means for a second.
Yeah, please do.
A PS ratio under 1 means the market is currently valuing this massive combined enterprise at less than the total revenue it generates in a single year.
Exactly. The market is screaming that it believes those billions in sales will basically never actually translate into meaningful profit.
Just totally writing it off.
Yeah. And that compressed valuation is precisely what makes the setup so interesting. Expectations are just in the basement. So any positive surprise on the integration front, even just a sign that the bleeding is slowing down, that could drive a major upward re-rating of the stock.
Right. A PS under 1 sounds cheap, I'll give you that. But valuation doesn't happen in a vacuum either. A lower margin business fundamentally deserves a lower multiple.
Fair point.
If that Foot Locker acquisition permanently dilutes the gross margins of the combined company, like if they are stuck at a 4% net margin forever, then paying almost 20 times earnings for retail business might not actually be a bargain.
Right. It might just be fairly valued.
Exactly. It might just be the new accurate fair value. And honestly, valuation is purely theoretical until you look at how actual buyers and sellers are behaving with their own money.
Which means we need to do a technical and sentiment check.
Let's do it.
And I will be the first to admit the chart structure is incredibly ugly.
It's bad.
There is severe technical damage here. The stock is down 45.4% over a 52-week period. It is trading uniformly and significantly below its 20-day, 50-day, and 200-day moving averages.
So it's in a pure downtrend.
Exactly. And look at the RSI. It is sitting at 16.88.
Wow.
Now, for context, an RSI under 30 is generally considered oversold. Hitting 16.88 indicates absolute capitulation level selling pressure.
People are just giving up.
The market hasn't just sold the stock, it has violently washed its hands of it in the short term.
Yeah, and as bad as that chart is, the most glaring warning sign to me isn't even the RSI.
What is it?
It's the insider activity. Insiders are the ultimate sentiment gauge.
Yes, absolutely.
They see the daily sales data. They know the reality of the integration better than anyone on Wall Street.
Better than anyone.
And right now, crickets. Despite the stock sitting at 52-week lows, there have been 0 open market insider purchases. None.
That is telling.
It is a massive red flag. Instead of buying, there have been 2 insider sales totaling over 20,000 shares.
Wow.
Yeah. The MSPR is deeply negative at negative 18.38. I mean, think about that rationally. When a stock loses 30% of its value a single day, and the executives inside the building aren't stepping up to buy shares at the supposed discount, why should we?
It's a great question.
If they aren't trying to catch the falling knife, it's a glaring warning for anyone trying to protect their capital.
It absolutely forces us to confront the bear case directly. We have to look at what could actually go wrong here.
Yeah.
And what the primary thesis breakers are.
Right.
Because there are 3 very distinct ways this whole thing falls apart.
Okay, let's hear them.
So the number 1 risk is pure execution failure. If the Foot Locker integration simply fails, like if those 31.9 million quarterly losses widen instead of narrowing despite closing stores, it proves the acquisition was a structural value destroyer.
They bought a sinking ship and let it pull them under.
Precisely.
Okay, that's the extension continuing to leak. What is the second risk?
The second major risk is fundamental. The core business deteriorates. If that 4.9% comp growth at legacy stores turns negative because the cyclical consumer weakness gets worse, then the only positive pillar holding this entire company up collapses.
And the third risk, which ties directly back to what I was saying about fair value, is margin risk.
Right.
The risk that the compression down to a 4.71% trailing net margin just becomes permanent.
Yeah.
Because if you permanently damage the profitability of what used to be a historically strong retailer, the stock is just dead money. I mean, it might not crash further, but it's certainly not going to compound your wealth.
I completely agree. We have to be honest here. The entire bullish thesis relies entirely on Foot Locker transitioning from a drag to a contributor.
Yeah.
If it stays a drag, the turnaround fails.
Full stop.
Right. But investing requires weighing both tails of the probability curve.
It's true.
We've looked at the downside, but if management actually successfully navigates these risks, we need to ask what the future actually looks like. And that leads us to the 3 to 5 year blue sky scenario.
Now, we need to explicitly state for everyone listening, this is an optimistic scenario.
It's very optimistic.
Right. It is a vision of what could happen, not a guaranteed prediction.
Exactly. But in a blue sky world, over the next 3 to 5 years, this company evolves into a highly profitable, dominant multi-banner platform.
Walk me through the actual mechanics of getting there, because hope is not an investment strategy. How do they physically achieve that?
So the mechanics look like this. First, those 110 store closures successfully cull the weakest cash-burning locations, stopping the immediate operational bleed. By year 2, Foot Locker reaches operating break-even. It literally just stops losing money.
Right.
And at the same time, the core legacy business sustains its mid-single-digit growth.
Okay, so the core stays strong and the bleeding stops. But what happens to the cash flow?
Well, as elevated capital expenditures, that $360 million a quarter they are spending on remodels and IT integration, that finally normalizes.
Because the construction is done.
Exactly. Once the heavy lifting is done, that money drops straight to the bottom line, sending free cash flow solidly back into the green.
Ah, I see.
And as a result, the combined entity captures those massive procurement synergies we talked about earlier. Margins recover back toward historical norms, and the stock re-rates sharply upward from that depressed 0.94 times PS multiple.
So it's basically a massive scale play.
Precisely.
Yeah.
If they survive the integration phase, they emerge as the undisputed heavyweight of sporting goods retail.
All right, so we've mapped out the grim current reality of the integration, the very real risks, and that blue sky potential of dominant scale.
Yeah.
What is the final wealth-building verdict here?
Based on all the research, the overall rating sits at a 5, which is a neutral stance.
Okay, neutral. And what does the base case actually look like?
The base case is that the Foot Locker losses do narrow gradually over the next 4 to 6 quarters. The core comps remain positive, but moderate a bit due to the macro environment, and the stock recovers partially as the extreme negative sentiment stabilizes.
So a slow grind.
Yeah, it is a plausible path, but it is absolutely not assured.
Right, and we have to remember the biggest threat to that base case is simply that the integration losses fail to narrow.
Exactly. And conversely, the strongest long-term driver for the stock would be a clear, sequential, quarter-over-quarter improvement in the Foot Locker operating results.
So who is this actually for?
Well, for a 6 to 12-month turnaround investor who deeply understands integration risks and is willing to stomach a lot of volatility, it's an interesting setup. The spring is coiled.
Right.
But for cautious capital preservers, investors who prioritize protecting their downside, the smartest move is likely to wait on the sidelines.
Yeah, wait for actual mathematical proof of margin stabilization in the quarterly reports before stepping in.
Exactly.
And as always, this is just our analysis, not financial advice.
Exactly. It's about understanding exactly what you are buying. You are looking at a great core business masked by a very expensive, very messy construction project.
And if you want to organize your own long-term stock research in one place and, track that construction project yourself, check out StockOracle through the special 14-day trial link below in the description.
Yeah, it's a great tool.
It combines company fundamentals, AI valuation estimates, bull and bear insights, moat analysis, comparisons, watch lists, and portfolio tools all on one platform. But remember, it is a research tool, not financial advice or a recommendation to buy or sell.
Right.
AI insights and valuation estimates can be wrong, and the data may be delayed, so always verify important information and make your own decisions. And this is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Talk.
Just remember the duplex. Keep an eye on those Q3 margins and ask yourself, are they finally fixing the leaky extension, or is the water slowly seeping into the foundation of the main house? See you next time.